The market does not reward hope, it punishes assumption. Before the open, most traders chase setups blindly, unaware that true opportunity lies in preparation, observation, and alignment with professional intent. The harsh truth nobody tells you: success isn't found in the tick-by-tick frenzy. It's earned in the quiet discipline of studying volume, price, behavior, and market structure before the first bell. Those who skip this step hand their edge to the herd. For example, a trader spends 30 minutes pre-market identifying absorption zones and testing prior support levels. When the bell rings, instead of reacting emotionally to the initial spike, they act decisively only when the market confirms their analysis, turning preparation into profit. Let me speak plainly, as I have always taught those who wish to understand the market beyond its surface noise. The difference between a professional and a speculator is not found in speed or in the luck of a single trade. It is found in preparation. The market opens each day not to serve you, but to test you. It will not pause for your indecision, nor will it reward those who chase price without comprehension. Before the first bell rings, a trader's work has already begun. This is the time to study, to observe, and to align oneself with the forces that move the market, forces that are often invisible to the casual participant. Price alone tells a story, but price, combined with volume, trend, and prior market behavior, reveals intent. The professional does not speculate, he interprets. He watches for signs of accumulation, signs of distribution, and the subtle efforts of those with deep pockets. These are the signals that dictate where opportunity lies. To enter the market without this preparation is to hand oneself over to chaos. It is the equivalent of stepping into a battlefield blindfolded. A trader who reacts to the opening print without understanding the context is merely participating in the crowd's emotion. They buy when the public is euphoric and sell when the public panics. They believe that opportunity exists because price moves, but in truth, opportunity is rare and it must be recognized, not assumed. Preparation involves a disciplined review of prior sessions, a careful assessment of where supply and demand have been absorbed, and a clear identification of points where the market may respond predictably. It is not enough to glance at a chart or skim a headline. One must understand the cause behind the movement. Where has the market tested supply? Where has demand proven weak or strong? Where might professional operators act to shake out the weak hands before advancing their position? These are the questions that occupy the professional's mind before the open. When the bell rings, the prepared trader does not flinch at every tick. He does not chase. Instead, he is calm, observant, and ready to act when the market confirms what he has already anticipated. The advantage of preparation is simple. It turns uncertainty into calculated opportunity. It allows a trader to engage the market on his terms rather than react to the market on its terms. Remember this fundamental truth: the market is neutral. It does not reward hope, emotion, or impatience. It rewards alignment, insight, and timing. Those who prepare before the open gain the ability to see through the noise, to distinguish the effort of professionals from the panic of the public, and to trade with confidence rather than desperation. In short, preparation is the foundation upon which every lasting success in the market is built. Neglect it, and you are merely a participant in someone else's game. Master it, and you join the ranks of those who understand not just the price, but the purpose behind it. Let me be perfectly clear. The market does not move randomly. Every rise, every decline, every pause carries meaning, but only to those who have learned to read it. To the untrained eye, price charts are nothing more than jagged lines dancing on a page. To the professional, they are the footprints of intent, the story of supply and demand, the very expression of the forces that control wealth. If you are to succeed, you must learn to observe the market's structure before you ever commit a single dollar. Market structure is not an abstraction. It is the organized pattern of highs and lows, of congestion and breakout, of absorption and testing. These structures reveal the battle between the smart money and the public. They expose where the operators are accumulating, where they are distributing, and where they are quietly eliminating weak hands. The public sees price only, the professional sees purpose. This distinction is everything. Before the market opens, you must identify key levels, prior support and resistance, points of congestion, and zones where price has previously reacted with significant volume. Study these areas carefully. They are not arbitrary, they are the battlefield. Accumulation occurs quietly, often near support, where demand exceeds supply and the public remains unaware. Distribution happens near resistance, where supply overwhelms demand and the weak are lured into holding positions too long. These are not mere guesses. They are the predictable consequences of human behavior, repeated in every market and in every era. Observe the shape of the market in recent sessions. Note where rallies have been absorbed, where price has failed to continue despite effort, and where tests have successfully confirmed strength or weakness. These patterns tell you more than any headline or rumor ever could. They are the map that guides the professional's decisions. Without this observation, one trades blindly, reacting to chaos rather than participating in opportunity. When the opening bell rings, you must already understand the structure. You must know where your potential entries align with professional intent and where you should stand aside. Observation is not passive, it is active intelligence applied before action. It allows you to distinguish legitimate movement from false signals, to separate the noise created by emotion from the true effort of the market's operators. Remember this, the market is a mirror of human behavior. It will repeat the same patterns, the same struggles, and the same victories over and over again. Those who learn to observe the structure can anticipate these patterns, acting not out of fear or hope, but from comprehension. They can enter at moments when supply has been absorbed, exit before demand collapses, and avoid the traps that ensnare the unprepared. Observation of market structure is not an optional exercise. It is the foundation of every intelligent trade. Without it, you are simply reacting. With it, you are aligned with the forces that move the market, and it is alignment, not speculation, that produces lasting success. Study structure, understand intent, and let the market reveal its secrets before you ever touch a trade. That is the way of the professional. Listen carefully, for this is a principle that separates the amateur from the professional. Price tells a story, but volume reveals the intent behind it. Many traders focus only on price, reacting to the movements of the chart as if they were the market itself. They see a rise and think demand is strong. They see a fall and assume supply dominates. Yet this is a dangerous illusion. Without volume, price is merely a shadow. It has no voice, no motive, no meaning. Volume is the language of the market. It is the measure of effort, the proof of action. When a price moves, but volume is weak, the movement is deceptive. It lacks conviction. Conversely, when volume expands in alignment with price, it signals the work of professionals, the absorption of supply, or the quiet distribution of assets. To trade without understanding volume is to trade blind, guided only by hope and fear. Before the market opens, the professional studies prior sessions with an eye on volume patterns. Where did supply resist the price? Where did demand fail to sustain a rally? Where did heavy volume coincide with narrow price spreads, signaling absorption or distribution? These are the clues left by those who control the market, the composite operators who move prices to their advantage. Volume does not lie. It exposes their hand if you know how to read it. Observe the subtleties. A broad price advance on weak volume may appear bullish to the untrained eye, but it often indicates that demand is exhausted and the public is buying into a trap. A decline on increasing volume, however, can reveal that strong selling is entering the market, even if the price seems stable. Every tick of volume is a note in the symphony of professional intent, and the careful trader must hear it, interpret it, and respond accordingly. Volume also teaches patience. Many traders act too quickly, entering trades before the market confirms strength or weakness. But a professional waits for volume to validate the move. Expansion on volume confirms that the market supports the direction. Contraction warns that the move is superficial, a mere reaction of the crowd. Acting prematurely is costly. Acting in harmony with volume is profitable. Never forget this. The market does not reward speculation, it rewards alignment. And alignment is achieved not by following price, but by understanding volume. Volume is truth made visible. It tells you where the professionals are acting, where the weak hands are trapped, and where opportunity exists. Study it carefully, and you gain insight that price alone cannot provide. Ignore it, and you are left to wander in the illusions of emotion, losing to those who understand the language of the market. In every session, let volume be your guide, your teacher, your confirmation. Watch for effort where it counts, and recognize deception where it hides. In doing so, you will trade with comprehension rather than guesswork, with confidence rather than fear, and with a sense of alignment that turns market chaos into opportunity. Let me speak plainly. The market is indifferent to hope, desire, or wishful thinking. Many traders enter the arena believing that patience alone will secure profits, that optimism will carry them through, or that luck will favor the brave. I have observed this error countless times, and the outcome is always the same. Hope without discipline leads to losses, frustration, and emotional ruin. Discipline, not hope, is the foundation of trading success. Hope is the temptation of the untrained mind. It whispers that a weak position will turn profitable, that a failing strategy will eventually work, that the market owes you a favorable outcome. The professional does not entertain such illusions. He understands that the market operates on cause and effect, on effort and result, not on human wishful thinking. Discipline is the bridge between analysis and execution, between observation and profit. Discipline begins with preparation. Before the market opens, the trader identifies key levels of support and resistance, analyzes volume to confirm effort, and notes the structure that will guide decisions. This preparation is meaningless without the discipline to act or refrain from acting according to what the market presents. One does not chase price because one hopes it will rise. One waits for confirmation. One does not cling to a losing position because one wishes for a turnaround. One exits when the premise of the trade is invalidated. Consider the psychological pitfalls that plague most traders. Greed tempts them to hold longer than reason allows. Fear tempts them to exit prematurely. Hope clouds judgment, masking reality with comforting fantasies. Discipline counters these emotions. It imposes rules, boundaries, and clarity. It teaches the trader to act on observable facts, not imagined outcomes. It is the steady hand that navigates the market's storms while others panic. Discipline is also about consistency. It is not sufficient to act wisely once and then abandon methodical behavior. The market tests you repeatedly. It tempts you with false signals, lures you with fleeting opportunities, and punishes deviations from your plan. Only those who consistently apply discipline, who follow the precepts of preparation, observation, and confirmation, can survive and thrive over time. Every trade must conform to your analysis. Every decision must align with your strategy. Remember, the market is neutral. It does not reward hope, emotion, or desire. It rewards alignment, insight, and timing. Discipline is the embodiment of that alignment. It allows a trader to distinguish genuine opportunity from illusion, to act decisively when conditions are met, and to stand aside when they are not. Hope is passive. Discipline is active. Hope is wishful. Discipline is observant. Hope is reactionary. Discipline is anticipatory. In the end, hope may comfort, but it does not profit. Discipline, rigorously applied, transforms knowledge into action, preparation into execution, and observation into opportunity. To succeed in the market, you must let discipline guide every decision, every trade, and every reaction. Without it, you are merely gambling. With it, you are trading as a professional. Let me be unmistakably clear. The market does not reward speculation, anticipation, or guesswork. Many traders believe that success comes from predicting price moves before they happen, from acting on instinct rather than evidence. This is a costly error. The professional understands that the proper time to act is not when one hopes the market will behave a certain way, but when the market confirms that conditions exist to support a favorable trade. Action on confirmation, and confirmation alone, is the cornerstone of professional trading. Confirmation is the market's validation. It is the signal that the groundwork laid through observation, analysis, and preparation has been recognized by the forces that move prices. A trader may study prior sessions, identify areas of absorption or distribution, and anticipate reactions at key support or resistance levels. Yet until the market demonstrates its alignment with these observations through price behavior accompanied by meaningful volume, any move is mere speculation, and any trade is a gamble. Before the bell, the professional identifies zones of interest, prior support levels that have absorbed supply, resistance levels where distribution is likely, and congestion areas where testing has occurred. But the trade is not entered preemptively. The market must confirm that supply has been absorbed or that demand is sufficient to sustain a move. This confirmation may appear as a breakout with expanding volume, a pullback with diminishing effort, or a retest of prior levels showing clear strength or weakness. Only then does the professional act, transforming preparation into profitable execution. Observe the dangers faced by the undisciplined trader. Impatience tempts them to enter early, chasing a move that is not yet supported. Fear tempts them to act on every fluctuation, reacting to noise rather than structure. Hope tempts them to anticipate success without validation. Acting without confirmation results in entering at the wrong time, suffering from false breakouts, and being caught on the wrong side of the market's real intent. Action on confirmation is not passive, it is decisively active. It requires that the trader remain vigilant, patient, and disciplined. It is the combination of preparation and observation applied in the moment the market signals agreement. A professional does not merely hope that the market moves favorably. He waits, studies, and then engages when the market has aligned with his analysis. This is the difference between trading as a professional and speculating as a novice. Remember, the market is neutral. It does not favor the impatient or the hopeful. It rewards those who act when the evidence is clear, when price and volume align with prior analysis, and when the forces of supply and demand validate the opportunity. Action on confirmation ensures that every trade is justified by fact, not fantasy, by evidence, not emotion. In conclusion, to trade successfully, one must wait for the market's nod before committing capital. Confirmation is the professional's signal, the moment when preparation, observation, and discipline converge. Only at that instant does the market offer opportunity, and only then can the trader act with confidence, precision, and alignment with the forces that move the market. This is how lasting success is achieved. Let me state this plainly. No one will hand you success in the market. The notion that opportunity or profit is freely available to those who wish it is a dangerous illusion. The market is impartial. It does not reward desire, luck, or hope. It rewards preparation, understanding, and alignment with the forces that actually move prices. Your edge is not granted, it is earned through study, discipline, and careful observation. To earn an edge, a trader must first understand the mechanics of the market. This is not a superficial understanding based on charts alone or on anecdotal advice. It is an intimate comprehension of the interplay between supply and demand, the behavior of professional operators, and the recurring patterns of human psychology. The market is a stage upon which the strong and informed act, while the weak and unprepared are swept away by emotion. Recognizing this distinction is the first step in earning an edge. Preparation is central. Before the market opens, the professional has already identified potential zones of opportunity, areas where supply has been absorbed, where demand has proven strong, and where the actions of large operators suggest the potential for predictable movement. This knowledge is only valuable if applied with discipline and patience. An unprepared trader might see the same patterns, but without context and understanding, they act blindly and lose. The edge comes from knowing what to observe, how to interpret it, and when to act. Volume and structure are the tools through which this edge is earned. Price alone can mislead, but when combined with volume and tested against the market structure, it reveals intent. Absorption of supply, testing of support, and distribution near resistance are not guesswork, they are signals left by those who control the market. Recognizing these signals consistently is how a professional builds an advantage over the crowd. The edge is not instantaneous. It is developed over time through disciplined study and repeated practice. Patience is also essential. Many traders seek shortcuts, expecting the edge to appear spontaneously. They chase setups, enter trades prematurely, or rely on luck. This is folly. An edge is realized only when preparation, observation, and confirmation converge. Acting without these elements is gambling, not trading. Acting with them is applying earned advantage. Every trade entered without this foundation erodes potential profits and exposes the trader to unnecessary risk. Finally, understand that earning an edge is a continuous process. Markets evolve, conditions change, and human behavior repeats but not always identically. A professional constantly refines their understanding, studies prior sessions, and adapts to new patterns while adhering to timeless principles. The edge is not static. It must be nurtured through vigilance, experience, and reflection. In conclusion, the market gives nothing freely. Hope is worthless, desire is irrelevant, and luck is fleeting. Your advantage is earned through preparation, discipline, observation, and alignment with the forces that truly move the market. This is the path of the professional, the one who understands that trading is not a game of chance, but a skill honed through knowledge, patience, and insight. To trade successfully, remember this always: your edge is earned, not given, and it is only through your own effort that you will achieve lasting success. Trading is not a game of luck, hope, or impulse. It is a discipline built on preparation, observation, and alignment with the forces that truly move the market. Success comes to those who study market structure, read volume, act only on confirmation, and earn their edge through patience and rigor. The market gives nothing freely. Every advantage must be earned, every decision justified. Master these principles, and you trade not as a spectator, but as a professional.